Hello, 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 and welcome. As usual, for all those returning, please just chuck a Y in the chat room. Sanjay Valentin, thank you very much for winning the race. Let me know if you can hear us, if you can see the shared screen. It's always helpful. Cool. It looks like everyone can. Fantastic. Looking forward to the session. Welcome to number 3, fundamental analysis. As
Hello.
usual, I'm joined by our editor-in-chief. Uh,
Hello.
Matty Alon. Matty, how are you doing? I hope you're looking
I'm
forward to the
doing
session.
fine. Yeah, actually excited. I'm sorry for missing the previous session, but they got the best technical analysis person, so they didn't miss anything of me being there or not. But yeah, exciting for today.
Yeah.
As you know, fundamental is close to my heart, so
Well, yeah, exactly. I think we've got
to
the
my
right
heart and to
passion.
my pocket. So yeah.
Yeah, exactly. Um, Let me just tell someone refresh if you can't hear. Any
Yeah, someone
issues?
said
It should
refresh
be
if you
fine though.
can't hear. Yeah, it seems like.
Cool. Well, look,
Just say
before
if you can hear us. Yeah.
Yeah, you can now. Fantastic. Well, before we do get going, as usual, just a quick shout out for the Digest and Invest. Hopefully, from a lot of you already, you're already listening to it. You're already watching the webinars, the podcast. We've had latest conversation with leaders episode, which is on YouTube, and the podcast Market Bites just dropped today as well. We talked about Tesla, Netflix, and bank earnings, which of course will be relevant for what we're about to talk to today. Matty's just put the link into the chat. Remember, you can go through all of these and check them however you want, or obviously go to our YouTube page as well. For anyone that hasn't watched the previous 2 webinars, you don't necessarily have to have done so, but it can be quite beneficial. So we started with the introduction to investment basics. We did day trading, technical analysis last week. We're doing obviously fundamental analysis this week, and if you're watching on demand as well, hello. And then next week, we're putting it all together. Build your portfolio. The links are in the chat as well. Let's get stuck in then. Let's get into it. Do take a moment just to check over the disclaimer. And as usual, do let me know where you're all logging in from. It's great to have people from all over the world in here as well. And any questions, please do use the Q&A whenever you see fit. We can keep an eye on that. Yeah, without further ado, let's get into it. So what is fundamental analysis? Well, look, last time out, we looked at technical analysis, which can help us potentially decide where to buy and where to sell. Today, we then focus on fundamental analysis, which can help us focus on the underlying value of an asset. So some of the ways we can do that include looking at the price to earnings ratio, growth rate, margins, EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, price to sales ratio, and debt to equity ratio. These can help us build our valuation of a specific company. We will discuss these as we go through, so do not panic. If it feels like a foreign language now, we'll get back to all of these points. But these are some of the ways that we can look to potentially value a company. The man on the right hand side here, Benjamin Graham, along with Warren Buffett, one of the sort of the GOATs, the greatest of all time investors. I would say at this point, this early on in the webinar, it's important for us to remember that when we decide to buy a company, we're buying the business. The stock market is just a place that helps us take advantage of buying it. So a nice quote here from what we call the father of value investing, Benjamin Graham. And he says, the stock investor is neither right or wrong because others agreed or disagreed with him. He is right because his facts and analysis are right. So look, we've all most likely been invested in a stock where we constantly check our profit or loss and start to get worried or excited. But what we're aiming for in this webinar is to help us make more informed decisions based on the fundamentals of a company. How many of you out there, and I'm raising my hand, how many of you out there have invested in a company and panicked maybe after a few months for whatever reason, got out, and then a few years down the line, it's done exactly what you thought it would, doing grow and grow and grow. and you're sitting there thinking, if only I had the patience and trust my actual decision. I've done it many times, but hopefully we can get to a point at the end of this webinar we feel more comfortable in trusting our actual judgment. Yes, I've done that. Yes, been there a lot. Yeah, me too. Me too. Happened to me 2016. Yeah, let's get some examples in there. And I can absolutely share some of mine as well. Look, number 5. Slide number 5. Over time, there's going to be changes in a stock price. Of course there is. You just need to look at, some of the recent share price changes of Meta from last year to this year, or Nvidia just over the last sort of 10 months, right? To see that, these movements can be for a number of reasons. It could be from a company beating or missing a specific earnings report, or other factors which we can touch upon later. In our diagram here, the blue horizontal line, it signals our perceived value on whatever company it might be. And if the price of the stock, the black line, goes below our value, then we might consider it an opportunity to buy a cheaper and, in our opinion, an undervalued price. On the flip side, if the price is considerably above our value, we might consider to take profit or not even enter the market at all. So from a trader's perspective, the long-term direction of the stock is pretty irrelevant. They want volatility. As long as it moves, they're happy. Okay. Now, I've got a quick question just before we do move on and go through some of the key terms that I think it's important to know. It should appear on your screen right now. And the question is, who currently uses fundamental analysis in their decision-making process? Yes, no, but I want to, or no. And I'll leave that there for a moment. Matty, just going quickly back to this chart, is this in a way kind of how you look at things? If we get a certain stock and it's in your period where it's undervalued, you're interested, and if it's above, you just say, you know what, for me right now, I'm going to leave it alone.
Honestly, for me, the straight line basically is the real business intrinsic value, right?
Mm-hmm.
That's what we call the real report fundamentals earning that we discover every quarter or every year. So if we look at the long term, the stock market is keeping up with the actual company performance. So as long as the company performance is doing well, I'm holding it. Obviously, in investing, just like when you buy when it's deeply undervalued, you will sell when it's very, very expensive. However, if it's up 10% above margin of safety with the intrinsic value that I like, I'm not going to run and sell, because we always need to remember that it's not easy as a value investor to find a company that you believe you can hold for the really long term. So yeah, we may see a drawdown, but because we cannot time the market, and if we believe that that the earning power of the business is not going to go away, I'm not going to just trade it. And we need to remember also there is another variable here, is that the capital allocation. If a company specifically that I hold is moving from 10% to 20% in my portfolio because it's up 100% and the whole portfolio didn't move, I may sell it even if it's below the trend line because it's managing the exposure. So there are many moving parts, but if it was, holding one company and this company is above what I think is the fair value, I'm not just going to run and sell it. It really depends on how expensive is that or how cheap is that. This is, by the way, it's also important. Some people buy something and it's down 5% and they get excited and buy more. No, this is not the game. The game, if you want to average down, you really want the share to be more down. I don't know, 15% or 20%, because then it makes sense you average down. If something is down 1%, 5%, it's not really mean anything. So that's just
No, very, very good advice. And actually, this all sort of brings us on to the next webinar next week when we're talking about building portfolio.
Exactly.
How much capital should we allocate to certain stocks or sectors, or, depending on risk profile too. The results are in. So 32% said, yes, I currently use fundamental analysis. 59, let's call it 60% no, but I want to. And a very small percentage say no, not at all. But that could change. That could change by the end of today's webinar. But thank you all for participating. And it's interesting to see some of the stocks that you feel like you've missed out on because you got out too early. Key terms to know then for us if we want to, be a fundamental investor, or at least be aware of what we need to know and understand. So first up, ratios. This is just the comparison of two or more financial data sets that are used to evaluate a business. A stock analyst, a person who uses research and analysis based on quantitative and qualitative data, valuation / intrinsic value, what the company is worth based on the discounted cash flow model. We'll touch upon this later on. Free cash flow, how much net cash a company has left over after paying its operating expenses and maintaining its capital expenditures. Capital allocation, the remaining free cash flow distribution, redistribution, and investment of financial resources to maximize stakeholder profits. Screener, a search tool that investors and traders can use to filter stocks based on user-defined metrics. And our final term, value investing, a strategy that involves picking stocks that appear to be trading at prices below their intrinsic worth. Let me know in the chat room if anyone uses anything in a screener. Is there anything that you always look for? Let me have a look in the chat. But we'll touch upon a few of these later on as well. Matty, are you trying to speak? If so, you're on mute.
Yeah. I'm sorry. I think because you just touched the value investing,
you got excited.
There was a question from Andy Hunter at the queue, and he asked, "I figure everything is in the chart already, so why should I worry about fundamentals since it's all baked into the price?" I think it's true and not, and I'll explain. I mean, if you look at value investing, well, the argument of value investing is that the market over the long term is efficient. Okay, so I would say that what Andy is saying, everything is priced in already. However, not all the time. So from time to time, we see mismatch between the results and the price. And that's Andy from fundamental perspective, what we as an investor and as an analyst trying to figure out what the market is missing. And I would just take the quote from Warren Buffett: "If the market was right all the time, I would be dumb in the street and just, collecting money," or something like that. That was the line that he gave. So there are definitely some misprices that you can take advantage of just because of the fundamental analysis. And actually, that's the goal of the fundamental analysis.
Yeah, absolutely. And people will have that view, right? Just this week. Yeah. I mean, some of the companies we've got coming out, let's have a quick look. So what are we now? We're Wednesday. So after the close, Tesla tonight, Netflix, you've got AT&T, American Airlines tomorrow. You've got Union Pacific. You've got American Express. This week we've had Bank of America, Goldman Sachs, Johnson & Johnson. People are thinking, hang on, are we now undervalued, overvalued? Do I need to get in, get out? So a lot of decision making can happen. People really like this time. And obviously, for American public companies, it happens each quarter. Moving on then to financial statements. So these are some of the things that we can look at: the balance sheet, cash flows, income statement, equity. And we'll just run through an example of one, looking at the main things and how we can all do this as well. Let's just crack on then with that. Income statement. So this shows a company's revenues, expenses, and profitability for whatever the reporting period is. Okay, so for American public companies, more times than not, it's going to be the last quarter. Okay, for Australian, for example, they do it semi-annually, but for American companies, every quarter. Now I'm going to look through these in just sort of a high level way, just so we understand them. But whenever we look at things like this, it is imperative to remember that we can compare them to the previous quarter, previous years, similar companies, competitors, but also the broader market as a whole, like the S&P 500. So today, this evening, Tesla, who could I compare Tesla to? Let me know in the chat. Who could I compare Netflix to as well? What streaming services might I want to look at? Okay, so net operating revenues refer to the total revenue generated by a company from its core operations after deducting any discounts, returns, and allowances. Gross profit represents the revenue remaining after subtracting the cost of goods sold, reflecting the profitability of a company's core operations. Operating income, this refers to the profit earned by a company from its regular business activities before considering interest, taxes, and non-operating expenses. Interest expense refers to the cost incurred by a company for borrowing funds or using other people's money to finance its operations or investments. Income before taxes represents the total earnings of a company before accounting for the tax obligations imposed by the government. Consolidated net income, this refers to the total profit or earnings by a company and its subsidiaries after combining their financial results into a single comprehensive statement. Now, at the bottom of this page, highlighted in red, you'll notice net income attributable to shareholders. This refers to the portion of a company's net income that is allocated to its shareholders, reflecting the earnings available to the owners of the company's common stock after accounting for expenses, taxes, and non-controlling interests. EPS, or earnings per share, indicates the portion of a company's profit allocated to each outstanding share of its common stock. It's calculated by dividing the net income attributable to common shareholders by the weighted average number of outstanding shares during a specific period. EPS is commonly used to assess a company's profitability, and it is an important factor in determining its stock valuation. So remember, with this webinar, you can go back and watch as many times as you want. So do take your time, but that's just a high level definition of each of one of these points here as well. This slide here, it's an important one. So if you're making your notes, focus, time to settle in. It's important for us because these are the things that the market and other fundamental investors like to focus on. If they focus on it, we've got to focus on it. That's the way to think about it. And that's why it's important. So revenue, it is essential to see if a company is growing its revenue. Again, we can compare this with ways we've mentioned before, similar companies, year on year, previous quarter, the S&P 500 if it's an American company, the FTSE 100 if it's a UK company. Okay. Gross margins, it is very important for us to see whether the company's profit margins is increasing or at least stable. And then their EBIT margin. So this is widely considered one of the most important measures of operational efficiency. And as a rule of thumb, companies with a higher than 15% margin have a powerful business model and a strong competitive advantage versus the market. So highlight that, write that down. If it's lower than that, you might not be interested. If it's higher, fantastic. And this is the way that you can start to make a little bit more sense when you look to do this yourself. So these are some of the most important points. Yes.
I want to interrupt for a second because
Happily.
there is a question, and I always like the question to answer them at the end, but I think it's relevant specifically when you just started to look at those numbers. And this is extremely important. I'm answering to Christopher Grotzner, I hope I said the name right, which he asking, would it be possible that you could check a company for me? I think it will be a good example for how you start the research. So on this, I have two very important things. First, we have the project that we call it the Digest and Invest Stock Break, where we take every time a stock and we break it down and we show. I just shared it in the chat, where we take a specific company and we will, like, literally in 25 minutes you can understand everything about the company from his history, fundamental, and the valuation. Now, taking a company and trying to do to everybody, we have thousands of people watching and participating here. So it's really hard to, to take for each person the company. However, and this is why I stopped Sam, what Sam is explaining now is literally relevant to every company. So you need to think about it this way. At the end of this session, you will see now like probably 5 slides, which give you the actual formulas and what makes sense from perspective of cheap or expensive, right? I mean, it's really relative to a company, but it gives you the understanding of what we learned from books and literally what you can do in order to practice your investing is build an Excel, put just like we build here, revenue, the growth rate, and then you have the formula. And then you can see if it's within the numbers or not. And you can compare it, as Sam mentioned, to the S&P 500, for example, or if it's a tech company, to the NASDAQ, and to at least 2 competitors and look at the past, I don't know, 5 years and then the last 12 months. This is exactly how you can build it, because I know, and that's why I stopped Sam. I'm saying that again, because I know many people are afraid of fundamental because they're like feeling that, wait, it's too complicated. I don't know how to deal with that. Believe me, it's not true. And at least if you're not going to be like 100% perfect analyst, you having the tools in this specific session to understand if a company is way too expensive or way too cheap, which is already giving you something. So, Christopher, I hope that was helpful for you and for other people.
Yeah,
Sorry
absolutely.
for interrupting,
No,
Sam.
no,
I mean, I
no.
just believe it was important.
No, absolutely. Thank you for interrupting. I think everyone would say the same. And actually, it got me thinking about something just in my head, which would, I don't like setting homework on these things. You go out and do what you want to do. But with the, being in the earnings season, or if you want to develop, you can practice these things. You can create an Excel doc with some of the key metrics. You can list a few different companies and their competitors and say, okay, based on what I can see now, I'm predicting. I'm not going to put a trade on necessarily, but I'm predicting that in 3 months, it's going to be higher than where it is now, or in 6 months, and then go back and review it. And once you get that confidence, then fine, put real funds in it. Remember, you've got the simulation account, Bonnie Toro, where you can, try this as well. So yeah, thank you very much for interrupting there. And it really brings us on quite nicely to the asset side. So let's talk about the balance sheet, and assets will be the first part. We begin with the asset side of the balance sheet reveals the resources owned by the company, including cash, investments, property, equipment, and all other valuable assets, which are essential for assessing solvency of that company, liquidity, and just the overall financial health. Again, when we do this, we can compare to previous reports and similar companies. But here we can just see a nice snapshot from 2021 and 2022 for this particular company. This company could be anything, but you can compare. How do they compare to a year ago for this, for that, and for the other? And then let me look at a similar company as well. And this is a habit you just want to get into. So that's the asset side there. The liabilities side of the balance sheet. This reveals the company's outstanding obligations, such as loans, accounts payable, accrued expenses, which are essential for evaluating the company's debt levels, financial leverage, and obligations to creditors. Just quickly, long-term debt. This refers to the portion of the company's financial obligations that extend beyond 1 year or the operating cycle, typically including bonds, loans, or other forms of debt that are not due for repayment in the short term. Okay. Account payable, this represents the short-term obligations or debts owed by the company to its suppliers, vendors, or creditors for goods or services received but not yet paid for. It reflects the company's outstanding invoices or bills that need to be settled within a relatively short period. This time it's usually within a year. Finally, down the bottom there, total equity. And here's the punchline. Equity is the residual value of a company after all its assets are liquidated and all liabilities to its creditors are paid. The formula for total equity is total equity equals total assets minus total liabilities. So it brings it all together there as well. And again, you can compare this year by year and so on. So hopefully things are just starting to make a little bit more sense here as well. Let's just move on here as well. These are some of the most important metrics, I would say, for us to consider. I think, again, this is the moment. If you're trying to take just a few things and the first time you watch it, maybe this could be one of those slides. What do we want to see? Look, a healthy balance sheet, as you can read up the top there, is very important for the company to continue its operations and weather rough times, because there's going to be rough times. We know that. We've seen that over the last few years. So we've got shareholder equity at the top there. This is a company's net worth, or the total dollar amount that would be returned to its shareholders if the company is liquidated after all debts are paid off. It's important to have a positive equity. Again, so that might be a tick. Things you're writing down, I want to see that positive. We also have current ratio. The current ratio is a liquidity ratio that measures whether a firm has enough resources to meet its short-term obligations. And then the bottom one there, you see debt to ratio. The DE ratio of a ratio evaluates a company's financial leverage. A ratio below 1, relatively safe, whereas values of 2 or higher might be considered risky. So if at some point you do create a bit of a screener for stocks that you're interested in, you've got a ratio there to have a look at. A ratio of debt to equity ratio, below 1, or avoid above 2, just as an example. So something for you to consider there. What is on the cash flow statement? The cash flow statement provides information about a company's cash inflows, but also the outflows during whatever specific period, including cash generated from those operating activities, investing activities, and financing activities. And it offers insights into cash position, liquidity, and sources and uses of those cash. So an investor can use the cash flow statement to assess the financial health and sustainability of a company. So, for example, if the cash flow from operating activities is consistently positive and growing, it indicates that the company is generating cash flow from its core operations, which is obviously a positive sign of profitability. If on the flip side, the cash flow from investing activities shows a significant amount of cash outflow due to excessive investments or poor acquisitions, it may raise concerns about the company's capital allocation decisions, be a bit of a red flag. Okay. So again, something to maybe consider there when you just sort of write your notes. Another big slide, I think, and I'm going to pass over to Matty at the end here, because for Warren Buffett, this is one of his favored ratios. It's important, obviously, as investors, that we analyze a company, we see growth over time. Margin is also important too. We want to see a company grow or sustain margins. So the free cash flow is used to adjust all non-business related profit and loss and show the actual cash amount generated by the business during that period. It's highly recommended to use the free cash flow rather than net income to value a company. And Matty, if it's good enough for Warren Buffett, it's probably good enough for us as well, isn't it?
Yeah, I mean, it's funny. I mean, not many people understand it, but it's not just good enough for us. It's how we live our life. And if you remember, you and I we give the analogy for our day-to-day life. So if we're employees, I'll put on the side the business people, but if we're employees and we get salary from the work that we're working, so we get our paycheck salary. So this paycheck is the net that's coming to our bank. This is sort of the earning per share that we made. However, at the minute that we put it in the bank, there is some credit card payment if we spend, and then there is some mortgage payment and all those things. And then you have the real net cash that you have available to decide what to do and how to allocate it. If you want to take it out and spend it, or if you want to invest it, or if you want to do whatever you want with it. But this is the true cash. And if it's positive and growing, it means that you manage your economy, house economy in a better way. The same is for business.
Yeah.
I mean, the real cash that stays, that's what it means. And then the CEO can decide to do few things with that, right? I mean, we know we can do allocation for investment in growth. So we can invest in capital expenditure or in intangibles and stuff like that. Or he can give it to us in two ways, or dividend or buying back shares, which both of them, it's like returning cash to the investor. And that's why it's so important to find companies that actually have a cash flow, a free cash flow, because, it doesn't make sense if you get a paycheck, but when you put it in the bank, you have so much expenses that at the end of the month, you have a negative cash flow. Sometimes, by the way, it can be because you made a big investment.
Yeah.
So you need to do the expense now, but this is why we're doing fundamental analysis to understand what's going on. I mean, if we'll take, for example, as you mentioned, Meta at the beginning, Meta put front and is continue putting lots of money in the metaverse, right? So maybe one day it will work, maybe not. No one actually knows, but this is taking a real cash flow. It's not like going and taking a debt just to do it. It's using a cash flow. Whether it's going to be successful or not, we're going to see that. But, this is just the way it works. So that's why it's extremely important, the free cash flow. Always look for the cash flow.
Yeah. And actually, just speaking of Meta, actually, let me just drag in the chart just to show people what it did look like during that period, right? I mean, this is a weekly chart. So if I just remove everything, make it a bit clearer for you. So this is going back to the left-hand side, 2017, and you can see, look, that's the previous all-time high in August, late summer 2021, came under big pressure. And this is where people who, around this sort of area saw value in the product, saw through that. And of course, holders of this stock have done incredibly well. And for those people that joined last week, where we looked at things from a technical point of view, look at this. Find me in a more important level on this chart here, from the high from the January 2022, the high from the 24th of January, the high from 17th of July this year. And then again, last week, we're knocking on the door. So think how sentiment could change, even for fundamental investors, if that level goes. So this is how you can use sort of both, in correlation with each other. But really interesting level there for Meta, 326, one to focus on, I am sure. Company guidance, important, really important for investors. It can provide an insight into a company's future expectations, can help investors make more informed decisions. So it's great. Can help them.
Especially now, by the way.
Yes, absolutely.
Take a look at the earnings season. Sometimes, one of the phenomena that people are looking, company beat the market, like on the up, on revenue, on net and everything. But then the company share price is crashing 10%. And this is because the management maybe reduced the guidance, okay? So extremely important to look for what's the guidance, because again, what we are trying to understand is the future. We don't know for sure the future, but if the management is saying, okay, we're raising the guidance, or we believe the guidance is going to be the same, and still the company share price is going down, so maybe the guidance for revenue is going to be the same, but they're going to say that the margin is going to be lower. And that's it. Do yourself a favor until next week when we meet again. Every company you're looking at, try to find what's the guidance mentioned was effect on the share price, and just throw it back to us next week. I think that's going to be an exciting assignment. There's the homework for you. So.
Yeah, absolutely. You've got it. So even if you're watching on demand, try and join live next week.
Yeah,
so
exactly.
You can do that. But, it is worth noting, not every company now does, forward guidance, but most do.
Yeah,
and I think it's important. It's also, we see how truthful they are over time as well. And remember, some of the biggest moves you get in markets, this is more, I guess, for the short term, but the biggest moves sometimes you get are the biggest shock as well. So that is something maybe for the traders to consider. If a company, is saying XYZ is going to happen, but ABC happens, sometimes you can get a bigger move from that, more volatility. Something just to think about. But it can be a big factor in moving share price, can be released via an earnings call, quarterly report, or even just a press release. But it is important to understand that guidance involves projections and not commitments. But just something to think about there. But there is your homework. Sorry, you've got it now. I didn't say it, but you've got it. Return of the GOAT, Warren Buffett, another good slide here. And over the next few slides, we're going to look at some ratios, multiples. I saw someone mention DCF earlier in the chat as well, so we can talk a little bit about that too. But here's a nice quote from Warren, which will set us up quite nicely for the next few slides. Intrinsic value can be defined simply. It is the discounted value of the cash that can be taken out of a business during its remaining life. So, without further ado, let's move on. And firstly, let's make the point here that the ratio valuation needs to be compared to the company's average ratio of, 5 to 10 years to its competitors and to the market. Have patience, have a long-term view, but also compare it to a big finding if you can. These ratios can be found on eToro, your Bloombergs, Yahoos, and so on. So first one, price to earnings ratio, shows how much investors are willing to pay per dollar. The lower the number, the cheaper the company. If you're only going to write something about that, the lower the number, the cheaper the company. Price to sales, another one where the lower the multiple, the cheaper the company. This shows how much investors are willing to pay per dollar of sales for a stock, commonly used for what we would call growth companies. ROE, return on equity, is a measure of the profitability of a business in relation to the equity. ROE higher than 15%, very good. The second point to make there, growing or stable ROE is essential. You can see these points in bold there. If you're just going to take notes, that can help. The price to earnings.
I would just point out, and Sam, we need to add it to the presentation. It's important. Equity, not many people understand what it means. So it's the net asset less net liabilities. So it's total less total. And the idea is that, asset, we invested money and we have liabilities against that. So if we take one less the other, then we have equity. And what we make on this equity showing us if we're running our business good or bad, because literally this is sort of I would say, the profit and the growth of the equity for the long term. So just wanted to point it out for someone if you don't understand what's equity means.
No, absolutely. And then the final one there, PEG, or the PEG, price to earnings to growth, or PEG ratio, gives investors an idea of a stock's actual value, like a PE ratio does, while also factoring in the growth potential of that particular company. And as a general rule, as you can see there in bold, a PEG ratio of 1 or lower suggests a stock is fairly priced or even undervalued. A PEG ratio above 1 can help suggest that a stock might be potentially overvalued. Again, if you're going to create a potential screener, these are things that you might want to look at to test yourself over the short to medium term as well. DCF calculators. This is I guess a good time just to shout out, if anyone is a club member, to speak to your account manager. I believe there's a discount of 10% that you can get for Guru Focus, which I have to say is a really good website. And I know, Matty, you're a big fan of it as well. It's something that, if you are a club member, I would at least, check it out, speak to your club, your account manager. But Matty, this is here. I mean, we've got Apple on the main screen, but we can look at a few others.
In the meantime, when you were talking, Sam, I asked in the chat, choose the companies you want us to go through Guru Focus. So
Okay.
I promise that we will take at least three. So
Okay. Pick the three.
I don't see Apple one of them. So I guess let's move to the real one. Let's start with what I see here. Let's start with Google. That's what I see, and then we can move
Well, at
forward.
least people know that we're doing this for real. We're not cheating them. This is live
No,
and direct.
for sure, for sure. And obviously, this is not an investment advice or anything like that. We just want to show how this working. So if you want, Sam, I can explain, and you
Yeah.
can just play with the numbers. So basically, the whole idea about discounted cash flow, just to understand the general idea, is that, as Sam pointed out, quoting Warren Buffett, is how much cash we can take out of this business over the long term, 10 years, 20 years, 30 years. Discounted cash flow, as the word is saying, is we need sort of a discount rate, percentage of a discount rate that will represent the risk we're taking. Because think about it this way. Let's say, for example, we believe a company can make $100 million in the next 10 years. However, we taking a risk for the company making the $100 million because not everything is for sure. But if we have an alternative of a 10-year treasury yield that giving us 4.8%, so we are not risking us almost at all, right? Because we need the US government to go down in order not to pay it. So the discount rate we need to take to compensate us for this risk cannot be only 4.8. It needs to be much higher because we can get it without really taking any risk. However, it also depends on the strength of the company. So what the discounted cash flow is coming here to show us is if we bake certain numbers, what the valuation, whether it's expensive or not. So if we'll start from the first, the stock price, we know the stock price. If we go earning per share, it's showing us what was the earning per share. We don't need to touch it. By the way, we can touch it only when we decide to do some adjustment and really deep analysis to understand. If you can look, Guru Focus is giving also the free cash flow. So Sam, where is your arrow? Yeah, if you press the cash flow, it's literally showing the free cash flow. So you can choose whatever Buffett suggested. And then you have the discount rate. What discount rate you want to give to Apple? Obviously, as we said, it cannot be like the government because the government is safer than Apple. Government doesn't have competition of Apple. So let's say, just for the sake of it, that it shouldn't be more than double than what the government. So today is 4.8, let's give it 9. Okay, so if we go with 9, then we have the tangible book value. We can ignore it, it's not that of a matter. And then we have the two important places, which is first is the growth stage. We need to decide how much we believe that Apple should grow in the next few years. Okay, I find it hard to find Apple growing for the next 10 years 20% every year, because Apple is not a small company, it's not a fast growing company. So I would say it will make it reasonable that Apple can grow at about, let's say, 10%. Again, I'm not an Apple investor. I'm just giving you the sort of the thinking about it. And then we can say that for the next 20 years after that, we don't need to say 10 years because we believe Apple is going to be another 30 years. So Sam, you can put in the terminal value, let's say 20 years. And then we can say that Apple can grow at least at a 6%. Okay. So if we take all of this, it means that Apple fair value is $127, which means that the margin of safety, it needs to go down 11% to be in the, let's say, at the price that you would say sort of a fair value. Again, as Sam just showed, Sam, can you increase the growth rate for the next 10 years to 15? Not this one, the first one. Yeah, for 15%. So if you believe Apple can grow 50%, 15%, so there you go. Easily it can be undervalued. And this is the whole hard work that we as a fundamental analyst have, because the numbers are the most important thing, right? We want to understand what we can do. By the way, Sam, if you press the free cash flow, for example, you can see what happened. It's a bit going down because the free cash flow is higher today. So again, it's all about, sort of what you decide to do here. But that's just for explanation. Now, Sam, let's move to another company. Which company we're gonna take? Someone wrote here oil. So oil, we can't do it because
No.
oil is a commodity. So thank you for sharing that. But what we can do it for a company that dealing with oil. Okay.
Exxon?
So for example, I see someone just posted CVX. Let's go with
Okay.
Chevron.
Cool. They
So
report earnings next
CVX,
week as well.
exactly. Reporting earning next week. I agree. Here as well. If you put a DCF, so we have the revenue, the profit. We have the price. We have the discount rate. I think 11% makes sense because, well, you know what? It's a very strong company because it has a very big control. So I would say, let's say also 9% here, because it's like it has a wide moat, although it has exposure to the what do you call it, to the oil and gas company. Now, growth stage, I don't think Chevron can grow 20% a year for 10 years. So I would reduce it maybe to 5 years and reduce it to maybe 10%. Which for me, again, it's something the way I think. And then 10 years, 4% make reasonable sense. Now, why it's important? Because think about it this way. We're talking about commodity. Obviously, if tomorrow the oil and gas is going to jump to $150 and it's going to stay like that for a year, what you're going to see is CVX making in 1 year like a full 5-year profit just because it's insanely jumped. So this is the big difference between Apple and a commodity-linked company like CVX, because there is certain demand the world is making, but if we're going to find a lot of oil tomorrow, so there is more supply than demand. Okay, so that's why it's a bit tricky one. And if you ask me, personally, I believe Chevron is the type of a company that you want to do as a dividend discount calculation. You also have it here. And the reason is that we know that they pay certain amount of a dividend. Okay. And then you can decide if you want to buy it at, I don't know, let's say they pay now at 5%, and you can say, you know what, I'll buy them only when they pay 8%. So it's not they're going to increase that. You can wait for the price to go down and then decide you're buying something at a discount, which give you a higher dividend. Just to get everybody that got confused, price going down, dividend is going up, because the dividend is an absolute number, but the percentage change because of the price. What else? Sam, let's take another one. I saw here Amazon a few times. Okay, let's go with Amazon. Cool. Amazon is the question. Someone in the meantime, until you open that, ask about Bitcoin. Bitcoin, the same, is sort of, well, it's not a commodity, but it's a sort of a currency. We cannot do DCF to that because, again, Bitcoin doesn't produce cash flow. It's not a business. It's not something with intrinsic value. Bitcoin is a pure supply and demand. Okay, and supply and demand, again, it's really hard to know what's going to be tomorrow or not. We all know the strategy behind the Bitcoin, that the fiat money, we printed too much money, etc., etc. Maybe yes, maybe no, but it's not something that it's very solid and strong. Amazon. So let's talk about Amazon. Amazon, what we can see here, we can see the price 129. We can see the the earning per share, and then the discount rate. Amazon, I think it's a very strong company. It can get maybe 8%. The sort of 8 or 9% like we had with Apple. Amazon definitely can continue grow because the consumer are growing. They can grow more than, 10, maybe more, but I would just to being conservative, I would go with 10%. Yeah, 10%. And then the next 10 years, well, it can go at 6%. I think Amazon can grow much faster than inflation because Amazon is pretty much controlling that. Something here looks doesn't make sense. Can you
let me refresh?
Yeah. By the way, it can make sense. I'm not investing in Amazon, so I have no idea what's So if you go to 10, let's put 20% for a second, just to see the growth. Okay, I just want to make sure. Or you know what? Can you press the free cash flow?
Oh, move. There we go.
No, it's even lower. Okay, I'll explain you what's the situation here. It's pretty easy. Don't get freaked out. And that's the reason why we see it there. So, Sam, let me show you something. Press the earning per share for a second. And it shows that Amazon make $1.27. Change it to $5. And I'll explain you in just a second why I changed it to $5. And then down you have the 10% and change it to 10%. And then you can leave the other one and then change the 11% to 8%. Yeah. Now I'll explain you guys something and it's important. Amazon is a company that invests most of its revenue in growth and invest again and invest again. And it's investing in two types of growth. First, the cloud. And the second one is building more warehouses and improving the logistics. I think the logistic investment is pretty, I would say, not end of the life, but not as fast as it was in the past. But the most aggressive investment is in the cloud. The cloud, if I remember right, and I, again, don't take me accountable for that, I don't invest in Amazon, it became profitable, but it's still not that high of a profit in compared to the potential, because Amazon is investing a lot of money and it make the whole numbers look not correctly. If we'll take, for example, let's say Meta. So Meta, what we learned is that if we eliminate the expenses they do on Metaverse, we can see that the profit is way, way higher. So literally tomorrow, if Facebook want to stop investing in Metaverse, the companies, the profit can almost triple in just one day. Amazon is the same issue. They invest a lot of money in the cloud. The cloud is growing very fast, is making money. So if you look 5 years time or 10 years time, when Amazon cloud will be at scale and mature, then you can expect that the price, the real internal intrinsic value earning is much higher. And that's why I put $5. By the way, it can be 6, it can be 7, and it can be 10. But this is how the market justify the price of Amazon. That's the trick about DCF, by the way, and you all need to be careful about it. That's why I said that, it's really important what numbers you're putting there. But yeah, especially with companies that are either losing money because, again, they invest a lot in growth or they're at the early stage of growth, the DCF is not necessarily the best thing to measure them. It's more for, I would say, companies that have a high profitability, like Apple, like CVX, and some other companies I've seen here.
Yeah, and
hope that helps, guys.
No, it does. And actually the feedback in the chat is this is exactly what I just needed. And actually what I would say for anyone watching live or on demand is save this, go back and watch it, really get to understand
Yeah.
it. I think it's been really, really helpful. I mean, Amazon, funny enough, is trading exactly where it was, over 3 years ago, middle of July 2020. It was actually above where it's trading now. So it is an interesting chart, it has to be said. We've given you homework. Now you've got books to go get if you wanted to, of course. But here are some ones here on the right hand side that you see, and when investing value, investors might have a look at these two here. As we mentioned before,
I actually have
Benjamin.
the book here.
Yeah, well, I hope you do. As mentioned before, Benjamin Graham is the father of value investing, and really, I guess, introduced it to Warren Buffett. We've mentioned a little bit before. We'll mention it again next week. But value investing is an investment strategy that involves identifying undervalued securities, stocks, etc., or bonds based on their intrinsic value relative to their market price. Value investors, as well, they sort of typically focus on analyzing those fundamental factors such as financial statements, earnings, and assets, and to find those stocks that are trading at a discount to their true worth. I'll put a link to those books as well. You can obviously take a screenshot as well, but we can put a link in there as well. We talked a little bit about this. You might as well have seen it on the Guru Focus page, but value investors use something called margin of safety. So margin of safety is a key concept within the world of value investing. It refers to the difference between the intrinsic value of an investment and its market price. Okay. So the margin of safety acts as a buffer, providing a cushion against potential uncertainties or errors, which we're going to have sometimes in estimating the intrinsic value. So by investing with a margin of safety, value investors seek to minimize the downside risk and enhance the potential for that capital appreciation, which is what we want. And they have room for error or unexpected adverse events while still making a potential positive return. So some of those events, market overreaction, so even just an earnings report, cyclical industries, which we've seen over the last couple of years, financial distress, hidden assets, low ratios, pandemics, you name it. Okay. These things, of course, can happen. Matty, margin of safety, right up there for you. This is something you pay a lot of attention to.
Yeah, well, so what Graham is telling us basically is we're all human beings and surprises can come every day. And it doesn't matter how much we believe our analysis is good and strong, just like when we went through now the DCF. So for example, let's say we put in, I don't remember what was the number for Apple or whatever, Google that we used in the beginning. So it gave us, I don't know, upside of 10%, or let's say a price tag of $150. So what Graham would come and say, okay, but put a markdown of 30 to 50% on that and then buy it. So Graham would tell you that wait for the for the price of Google to go down in 50% before you buy it. And then you would come to Graham and say, is he insane? Who's going to wait for Google to go down 50%? Even COVID, it didn't go down 50%. And it's both true. And it's important for everybody to understand why. Because first, in Graham days, Warren Buffett early investing and everything, companies used to trade at 4 times earning, which was really insane valuation. The market was less efficient, way less efficient. I would say today the margin of safety needs to be more of understanding of the discount versus the quality of the business. As much as the business is a high quality, just like Sam and I used to look at Google and Meta in 2022. So our discussion was that, I mean, yeah, we don't know what's going to happen, but one day people will go back and continue advertising. And if you want to be an advertiser, you're probably going to use one of the two, right? Either it's Google or either it's Meta. So it has a lot of value quality into it. And then if it has a good price, that's how we decide what to do with that. But again, it's really depends on a specific company. So just giving you an understanding of the margin of safety and, the comparison to the history versus today.
Yeah, absolutely. Quick summary. We're pretty much bang on time, which I think is amazing how we've managed to time it so well. We obviously can go through a couple of questions if there is some. Take everything into consideration when doing fundamental analysis. Remember what we said about comparing it to previous quarters, previous years, similar companies, the broader market index. So if we were looking at those companies that are reporting tonight, Tesla, Netflix, okay, well, what have the other companies in the S&P 500 done? If I'm looking at Netflix, I might be interested to see what Disney did with their streaming service. How can it compare? Who's got the bigger market share? How has that changed over the quarters and years? Know your time horizons before investing. Don't rush decisions, especially immediately after an earnings announcement. And that could mean even just taking the position off if you've got one on. Patience is key in this game. And hopefully over the last few episodes of this, you've really started to understand that. You can also think about the current macro picture too. And sometimes I think we can all be a little bit guilty of getting into a stock or being invested in a stock that we believe is going to do very, very well over the 5, 10, 15-year horizon. And then suddenly a bad macro picture happens for whatever reason. And our stock, just because the whole macro picture isn't great, comes under a little bit of distress. We sell, things get better. And that stock that we thought in 5, 10 years is going to be higher did exactly that. It is also worth noting that over the last 15, 20 years, Amazon and Apple have had periods where they've come down 90% or more. And of course, over that period are now hundreds of thousands % higher. Patience is key. I'm not saying every stock is going to do that, but those big winners, especially with compounding, can really make such a difference. Develop a consistent process as well, and something we're going to focus a lot more on next week's episode, where we bring it all together. We're going to build a portfolio live together. And obviously, you can watch this as many times as you want. Let me know if there are any questions, Matty, you want to go over. I saw one earlier just about links to the other episodes, so I'm just going to put that in the chat as well. You can watch as many times as you want. You can join. You've already done the link. Amazing. You can join next quarter too.
We can take some Q&A, and I see we have 15, so we have time to do it. So let's start with David Becksire. The problem I face, and I suspect others have, is where to start, where to move on paste copy trading. So I would say that the way to start is first with discourse, right? I mean, as Sam mentioned, we're not here to give homework, but like anything in life, you have the base, and the base should give you the tool to move to the next stage. I'm 22, almost 22, 23 years analyst, and I'm still studying. Reading a lot. Reading can be from various places. It can be from famous books. It can be from listening to interviews or practical analysis like we have in the Digest and Invest that we shared with you. It can be in many, many ways, listening to podcasts, listening to many things, and asking people, following maybe blogs about investing, and just getting even in eToro's, the feed community, you can ask people. We have a lot of value investor, popular investor, and regular investor that you can always ask and learn. Don't be shy. That's my advice. You're not sure about something, you're a beginner, ask question. And this is the only way you can get to that. And one of the things I like that we have is a demo account. You don't have to invest money. You don't need to risk money. Start with a demo account. See that what you're doing is the right thing. We're here that will make sure that when you put the real money, you will understand what you're doing.
Yeah.
Next
I've got
one, DCF model.
I've got a
Yeah, go.
quick question, which I think is a really good one. As an 18-year-old, I constantly make profit in the virtual portfolio. It's always easier, isn't it, on a virtual portfolio? But
Yeah.
lack the funds to make enough money to make real profit even long term. What should I do? And this is a great website. Okay. Compound interest calculator. So let's say you start with zero, and we get, let's just say you go for the S&P 500, which we know annually over the last 100 years, 10%. But let's say it doesn't do 10%. So we're going to under predict, let's do 8. Okay. And you're 18. So you're thinking, okay, well, let me do 40 years. You'd only be 58 by then. And let's say monthly, you can only do, let's just say 100 a month for that whole period, which I know it sounds cringy to say, but that's like a coffee a day. Okay. And let's see what that would be. We'll calculate that. And that's doing £100 a month, so 1,200 a year. Okay, so over that 40 years, you would have invested 48,000. Okay, from doing that, that's just $100 a year, £100, €100, whatever currency. But that would be what you've got, 349,000 off 8%, doing it for 40 years. So you can see it would take a long time to sort of grow, but this is the power of compounding, right? So year one, you're at 12. You'd be at 12.44. So you'd have made £44. And this could be off-putting. You think, well, why would I invest for a year to get £45? But look what happens just when you get that 8% year on year, and you can see how it grows and grows and grows. Because obviously 8% compounded on 27,000 gets us to 30. That gets us to 34 as well. So I wouldn't be put off by the fact that, oh, even in the long term, I'm not going to make money because I'm only going to get 8%. 8% in the long term really does start to compound. And then suddenly when you say, you know what, I'm going to do £250, and actually I do get that 10%, or not 810%, I do get that 10% a year, then suddenly you can see numbers where it goes to 1.5 million, for example, when you've only actually invested 120,000. So time is on your side at 18 years old, and you don't need to have a lot of funds to do that. And by the way, even if it was just, say, I don't know, 50 quid. Instead of that, again, you can see what 10% for 40 years would get you, and it's that, and it can build up. So I think it's a really useful website.
By the way, I think if you go to 20 years for a second, Sam, show me, 20 years.
Doing how much a month?
Yeah, no, the same, 50, which is, let's say it's something reasonable that as an employee you can save. How much is going to give you at the end?
So 37,900 from a 12,000.
Okay, so this is always something I'm showing to my friends. Some of you maybe just had a baby coming, or some of you gonna have a baby in, I don't know, in a year or 2 years or 3 years or 5 years. And you're still young and you don't think about the long term. And I'm telling people, just take this small amount, throw it under your kid name for 20 years. Anyhow, is there at your house for 20 years? You're literally going to have the amount to pay for their university, to
college,
pay for the college. You're going to have the amount. Exactly. I mean, this is the beauty part about the long-term compounding. And even if we don't think about it and we want to spend the money right now and do all those things, believe me, do yourself and your kids a favor. Take a small amount in a separate account, something that you cannot touch. You know, it's only for them. Just deposit every year. This is just a pure magic for that. And then when you get to the 20 years, you're going to feel sorry you didn't put more money in that. But it's okay. This is the learning curve. They will learn how to do it better.
Yeah, but in the 20 years, you might think, oh, do I actually just not tell them that I did this for them and take the money myself? But but yeah, no,
that's gonna be brutal.
Yeah, exactly. Well, it shows the patience. It shows the art of compounding as well. So yeah. But Louis, hopefully that helped your question there. And as 18, you've obviously got a long period ahead of you, and patience, long term mindset will help there big time. Any other particular questions, Matty, you wanted to address there? I mean, we've gone through quite a few already.
Yeah, I mean, we can have few things. First is Vincent is asking about how much truth can we expect from company guidance. This is a very, very good
Mm,
question. You know that Warren Buffett once said that if you could rule, the reporting, it would eliminate any company for giving guidance because
mm,
guidance is something that it's really hard to give unless you're a company that know in advance. For example, an oil company can know in advance companies that order or close the inventory from them. However, if it's attached to the variable price of the oil and gas, this is like, to be a magician in order to know what the oil and gas prices is going to be tomorrow. So the guidance, a company, if over the long term, and it's easy to see that in many sites that the company is beating expectation of their own guidance, it means that the company management is taking a precautious guidance. So they always put to themselves a margin of safety. That's why they're easily, beating the guidance. So you want to take a look at it. Sometimes, unfortunately, uh, some companies are just giving like a crazy guidance, especially when you have a new management and they're not beating it. And what's happening is the share price is just crashing. So that's for that. Why someone asks Sam, why does Buffett hold so much Apple? I can take that.
mm.
Well, Buffett, I would call it, is like the best baseball player in the world. And what I mean by that, he's waiting for the best swing he can make. And sometimes he waits 5 years in order to put a big bet. When he finds it, he just hit it very strongly. However, not all of us are Warren Buffett. Not all of us have the capabilities of doing like a really deep analysis, getting the insights from meeting with the CEO and everything, around that. But when he finds something that big, is that mean that he's always right? No, that's why you have sort of diversification. And of course, you guys, when you don't have the capabilities, definitely have much more diversification because it will just protect you. In addition to that, it's important to understand because not many people acknowledge that, is that if you look at Apple exposure of Berkshire Hathaway out of all Berkshire Hathaway, not out of only the portfolio of the equities, is not that big like everybody is looking. Because when you look at the equity, it seems like it holds, I remember, 50% or something like crazy. But if you compare it to the whole Berkshire portfolio, I think it's 20%, which is also high, but it's not like it's risking the whole business. So that's just on that. What else we have? Do the ratio of big cap companies change often and much during the year? Well, it depends.
Mm.
See what happened in 2022. The whole large cap just crashed, right? The whole so-called fan companies went down 40 or even 50%. I remember Sam and I was talking about it, that everybody thought that those big solid companies cannot go down, and we saw Google, Amazon,
Yeah.
all of them going literally between 30 to 50%. So there is no safe haven aside from bonds. And also that, by the way, bonds of the government, and also that, by the way, is only if the government survives. So also, this is not a risk, 100% risk free. How about crypto? Does staking rewards, does it count? Sam, you want to take on crypto? I'm not a
But
crypto
no, I mean, I think
professional.
with the crypto stuff, we will focus on it a little bit more next week when I build a portfolio. And depending on someone's risk appetite, they may want a bit more exposure to crypto. So we can talk about it then, Kim. Feel free to join next week, same time. as well. Okay, but where do you put this £100 for 40 years? Obviously, we're not going to say, look, do this specifically. But what you can do, of course, is have a look at different ETFs, exchange traded funds that you might want exposure to. And you can, of course, look historically to see what they average per year. So in the first webinar, we talked about some of those, the S&P 500, the top 500 companies in America, the average return of the FTSE, the Hang Seng, the NASDAQ, and so on. So do feel free to go back and watch that. See, you might also have a view that you think a certain part of the world is going to do very, very well over the next 10, 20, 30, 40 years. Or you can diversify and say, instead of doing, say, £100 on that, I'm going to do 25, 25, 25, 25. And then spread that risk. Okay. But I would recommend going back and watching that first one, but also next week as we sort of build a portfolio together. Sir,
I can take one more question I saw here, and we can finalize with that. Is David tend to ask if you can, what percent of the portfolio should you advise to have in cash to take advantage of the market, to get the fair value of the company, dividend or not? This is a tricky question. It depends who you're asking. If you would ask Warren Buffett, he will say that will be fool to have cash just to time the market, because no one knows what's the market going to have tomorrow. And sometimes you can wait 7 years, sometimes you can wait 1 month, and then you become the smartest person alive. Over the long term, if you know you can make, 10%, over the long term, it can be down, up, but you can make 10%, it makes no sense to hold cash, because this cash is not going to make the 10%. Okay. And again, when I'm saying it doesn't make sense to hold cash, it doesn't make sense to hold cash when in your portfolio of investment, right? If your whole basket of asset as a person is 10% cash, 10% real estate property, and then 80% investment, the idea is within the 80%, it doesn't make sense to hold cash. Okay. But again, it really depends on your strategy. If you're a value investor, not value investor, if you're a market timer, not market timer. Obviously, Sam can tell you a lot about if you're doing technical analysis. You can finish the day with the cash in the account. Always, you don't want to be exposed. So there are so many things, but in general, rule of thumbs, cash doesn't make money. Cash is actually losing money because of inflation. But we will speak about it also next week when we talk about capital allocation. Sam, I think we're good here, and I hope.
Yeah, we'll wrap it there for today. Of course, if you're watching on demand, watch as many times as you want. We'll be back next week, same time UK, 3 p.m. And then you've got to work out where you are based in the world, what time that would be. But same time as this week. Build your portfolio, but remember, you can go back and watch the intro to investing, technical analysis, and fundamental analysis whenever you want, with the same links that you've signed up with. I hope you all have a great rest of your Wednesday, unless you're in Australia and New Zealand, and then have a good Thursday. But I hope you have.
Do us a favor. Only one request, and it's an important request. We invest a lot. Well, actually, Sam and Josh and all the team invest a lot in, in content they're producing. We shared the link for Digest and Invest. It's for you. It's going to increase your education. There is 100% benefit only to you. Press the like, press the share, spread it with other people, because it's important for us to give more and more education, because it's part of the whole loop. It's not just sitting and watching 4 sessions and that's it. You're going to be a super investor. It's consuming content on a daily basis. So thank you in advance for that. But it's important for us that you will share and you will like, and obviously rate us if you like it and you appreciate the quality.
Yeah, absolutely. I second all of that. But look, guys, hope you all have a good one. Take care. And hopefully see you all next week, whether live or on demand. Take care. See you later, Matty, as well.
Stay safe. Bye-bye. Bye-bye.
Bye.